If you are currently making biweekly payments on your mortgage loan to pay it off faster, I want to open today's session with two critical mathematical questions. First, did you know that many traditional mortgage servicers don't actually apply your biweekly half payment to your balance the day they receive it, but instead hold it in a non-interest bearing escrow account until the second half arrives? Second, if your money is sitting idle, waiting for a monthly processing date, how much daily compounding interest are you accidentally leaking to the lender? Let's look at the baseline math. So we have a homeowner with a $400,000 traditional mortgage. They switch to a biweekly schedule, sending half their payment every 2 weeks. They assume that because they are paying more frequently, they are instantly suppressing the interest charge on their balance. This highlights a structural misunderstanding of traditional amortization. So to resolve our first opening question, traditional mortgages calculate interest monthly in arrears based on a rigid amortization schedule. Sending money early often doesn't change the daily calculation because the contract rules dictate when the principal reduction is recognized. The main reason biweekly payments shorten your loan is simply because 52 weeks divided by 2 equals 26 half payments, which forces you to make one extra full payment per year. It's a budgeting trick, not a structural interest change. This brings us to the answer to our second question and why we look at a superior debt instrument to execute true acceleration. Imagine instead utilizing an alternative debt chassis that calculates interest on a daily simple interest timeline combined with a daily cash sweep function. In this environment, your payment timing changes everything. The moment your income deposits into the account, a daily cash sweep automatically pulls that capital against your outstanding balance. Because simple interest is calculated every night based on the exact balance remaining that evening, every dollar of your income actively drives down the interest charge for every day it rests there. Consider a structural migration. Instead of relying on forced extra payments that sit idle in an escrow account, the underlying housing debt is migrated to an instrument that recognizes the velocity of your income on a daily timeline, ensuring your money works for you every single night. You look past the biweekly illusions, examine the daily interest calculations, and deploy your cash velocity strategically. That's how you execute true housing debt acceleration. Comment sweep or send me a message to examine how a daily simple interest framework compresses your loan payoff timeline and total interest paid.